Hey, Matt Hullander here with V2 Strategy Advisors. I've got one of my partners, James Purgason, with me today. James is really the most experienced M&A guy on our team, and today we wanted to talk about some lessons that most business owners maybe learn too late or blind spots that they maybe didn't think about ahead of time. And I lived through it, and I know you have dealt with several business owners going through the process. So I've made a list of questions. Some of them I may need to answer. Most of them you can help answer. The first one we're going to start with is, what's one lie that business owners maybe tell themselves?
Oh man, I'd say the biggest lie business owners tell themselves is they usually intimidate themselves, that they need to be the best or smartest or have the most efficient company. And I'd say just tenacity is the common trait I think successful business owners have. It's the ability to adapt and overcome to problems and issues. And I think people intimidate themselves when they shouldn't.
Yeah, they've worked hard to get where they at, so they've been doing something right.
And it doesn't happen on accident.
Right, and it takes a lot of time. You know, all the social media now that acts like you can have overnight success, I laugh at, because that just doesn't happen.
Well, imagine we all put on social media the best parts of our businesses. We don't highlight the things we're all struggling with. Yeah. But as you and I know, I've never been in due diligence on a perfect company. Right. Even the best companies there's something that could be changed, fixed, or better. So again, it means you focus on your positives. Social media doesn't give an accurate representation of what most businesses look like. And you just kind of got to remind yourself that if you're making progress, you're doing something right.
Well, and I think a lot of companies, and we had lunch with one this week, they would like to exit, but they're maybe just not quite there yet. So maybe today we can talk about some things they need to put in place that will help them. And we've covered it in the past. And without going to the next question, let's just cover a few of those now. Accurate financials. Talk about how important that is. And it's something that I think we see most common as inaccurate financials.
Yeah, and especially in the small to mid-sized business world, because most of those companies aren't going to have a full-time controller, certainly not a CFO. So they're really relying on the owner's skill and knowledge to drive financial reporting. And that's one of the big value propositions we provide, is we'll go in there and make sure before we even go to market, we're going to make sure the financials accurately represent your company's positioning in the market. That's step one. Then we work on EBITDA multiples, things of that, once we know what EBITDA is.
Well, and a lot of times I assume once we help them get the accurate financials, it can sometimes be a surprise. Their EBITDA may be higher than they expected. It was that case for me.
I'll give you the example of who we met at lunch with this week. He sent me financials yesterday, and they were cash basis, which is typical for companies in that industry. But I said, hey, you're kind of shorting yourself. All transaction multiples are assumed you're on accrual basis, GAAP. And accrual, if you're a profitable company, will always be higher than cash basis. So we're actually going to restate their financials in accrual to show an accurate picture, which only gives them better news.
Sure.
Because they thought they were applying a multiple on cash basis. Turns out we've got another 10, 15% to squeeze out of there and then apply the multiple on that.
Well, and that's something that our company loves to help business owners do, and it's what James will do right out of the gate, is we'll have a data request and get the financials and do what you just said, which I think all business owners need. Couple other things that I feel like are important, and you and I also ran into this with two brothers we met with. They were running the company, and so if a buyer comes in and they want to exit the company, who's going to run the place now? So having a key number two or a president in place, talk about how important that is from the perspective of the buyer.
I mean, I would say typically that's an ideal scenario. Most buyers, when they come in, they may have ideas of organizational changes they want to make, but they're rarely going to impact them day one. And two, they kind of want to be able to observe the GM over time and see, is this our guy or gal that's going to help us drive our vision into the future? Especially with smaller private equity or individual buyers, that's going to be a lot more of a need. Larger private equity groups have more confidence. They've got headhunters, recruiters. They'll go find someone if they need to. So it's not impossible to sell if you don't, but it certainly makes it more difficult, and just different conversations we have to overcome those hurdles.
Well, and they would most likely ask the owner to stay on for a while anyway, so they can work through that while the headhunter's helping them find the number two. Typically, how long is that? And do you see that? I feel like in the last few years, private equity realizes, hey, we're buying this business because this person's made it successful. They have the relationship with the employees and the culture and the vendors and the customers. So I think they've been staying on a little longer, and if owners are willing to do that, I think it's only helpful.
Yeah, it certainly only helps because it provides for a cleaner transition. There's institutional knowledge that's housed in that owner's head that just usually doesn't exist anywhere else in the organization. So it's certainly a benefit, but as far as what people are asking, it's different. I see it all over the place. I will say private equity, the 80s that used to come in and clean shop and install their own management teams, those days seem kind of over. I don't think that ever worked as well as they'd hoped, but I've seen 60-day full-time transition periods, and then transitioning more a consultant role, and then I've seen 2, 3, 4, 5-year transition periods, but usually those will have a rollover equity component and some kind of incentive.
Well, that rolls into our second question, which I want to maybe answer for us, and then I want your opinion because I'll answer it from my perspective. But I've always been big about what is the vision? What's the vision for the company, and how do we get there and work backwards to achieve that? Well, it's the same. I think we can do the same thing. The question is, what's the most expensive mistake that owners make before selling? And for me, it was not having a vision of how I wanted the sale to go, not knowing all the options that I had. Where was I going to be a year later? Was I still working there or not? Did my company name go away or not? How was the culture? And so that was a mistake I feel like I made. But aside from that mistake, what do you see a lot of business owners doing that maybe could have helped their evaluation or the process go smoother?
The first is, frankly, it's surprising to me. Most business owners, I find, undervalue their company based on public data and stuff they're able to access, which is different from, you think most people tend to overvalue, but I think because private markets are just so obscure and folks don't know how to access the data, it's tough to really feel confident about what the value of your company is. And frankly, Matt, most business owners will only meet someone like you or me that does what we do once or twice in their lives.
Sure, and I totally agree with that answer. And I think that would, for anybody watching or listening out there, you may have a lot more value than you realize. I know my EBITDA, when I understood how the ad backs worked, it almost doubled.
I've met how many people we talked to that said, I thought I was just going to shut the doors.
Yeah, and they may sell a customer list or some assets, but they don't realize the real value that they have in the company. A lot of these buyers, they're not just buying, they're buying a lot of things. They're buying your website, your name, your reputation, maybe your license, your phone number, your employees, your culture, your brand. So sometimes that's easier than them coming to town and it'd take years for them to do all that.
And that's the business thesis. The math problem they're doing is it cheaper for me to come into the market brand new and compete head to head and work up that revenue, or is it cheaper to acquire by acquisition? And generally, where multiples are, I would say it's generally cheaper to acquire and grow by acquisition. And that's why we see these robust markets.
Yep, I totally agree. All right, next question. What is something that buyers care about that owners may ignore?
Management teams, robust management teams, that's something buyers always like to see, but is rare in the lower middle market because typically you got your owner, but you don't have a fully built out C-suite.
And systems. I see that a lot. They've been doing it and working hard and wearing all the hats, but they don't have the systems in place.
Well, think of the electrician that's a great electrician and going out and doing great projects, great company, steady revenue, great reputation, but they really they're not able to track or access their data internally because they don't have good data management or tracking systems. So it becomes difficult to communicate that value outside of the financials. And most buyers are looking at, okay, the financials tell me a broad financial story, but I need to know how the cake is made.
Sure.
So that I can continue making it.
All right. If I know this will be tough for you because you're a numbers guy, so I'm assuming it may have something to do with numbers. But if you only have 15 minutes to evaluate a business, what would you look at?
First thing I'm looking at is profit loss statements and balance sheet. I'm looking for anything new and weird compared to the industry. And I'm immediately doing a mental exercise of what do I know about the industry? How does cash move through the business? Are there a ton of advance payments or deferred revenue that we need to be aware of? And so it's really just understanding how they make money, how they spend money, what drives that, and then looking at the financials and saying, does that story match up with what I generally understand about the industry? And if not, and usually there's some question mark there, something looks weird, that kind of starts me diving down a rabbit hole and just understanding why. Because ultimately, we've got to be able to communicate to a buyer the same messaging.
Yeah, and kudos to James because he has the innate ability to see that where a lot of owners don't see it after years of being in the business. Okay, what's something owners obsess over that buyers really don't care about?
Legacy. And I won't say buyers don't care about it, but it's certainly not the forefront of their mind because they're focused on their legacy now. Mm-hmm. But I'd also say I think the fear is a little bit misplaced. And the phrase I often use is no buyer wants to come in and spend $5, $10, $15, $20 million and run the company to the ground. You know, they know what's worked.
Sure.
And yeah, your legacy is not going to be at the forefront of their mind, but they also don't have a natural incentive to fail or to ruin that legacy. Frankly, why they bought you is because you built that legacy and the branding and the strong foundation.
I agree. All right, next one I'm going to try to answer and then see if you agree or not. When should an owner start preparing to sell their business? I don't think you can start too early. I feel like you should always be putting the systems in place and have accurate financials and have a good GM or a number two. Because let's say you don't sell, you're still building a better business if you're preparing to sell it. But aside from that answer, let's say you know you want to sell sometime in the future. Is a year long enough? Is 6 months long enough?
You know, I break that up. I think in terms of when to start thinking about it, it's never too early. If you know in 20 years from now you're going to sell the company, you're going to start to build the infrastructure to support that.
And I think that's what most people do not do. There's guys out there just doing it, and they haven't even thought about it.
Well, let's be honest. You've ran a company. That's the not fun stuff, right? That's not out there selling your product, generating revenue. That's the fun stuff everybody's good at. But getting your back-end enterprise management systems, getting your data, the data you capture, stored, housed, and able to be segregated accurately so you can utilize it to make better decisions. And that's all the not fun stuff that people don't love doing, but actually adds a lot of value on the back end.
Well, and something for those business owners to think about, you are going to exit one way or another.
Right.
You're going to give it to your kids. You're going to have to close the door one day. You might go bankrupt, but hopefully if you plan properly, you can have a successful exit and maybe change generational wealth because of what you've built. So you're going to exit one way or another. Let us help you figure out how to do that and go ahead and start thinking about it.
Well, and as you know, you got one shot.
Yeah.
You got one shot at the biggest financial transaction of your life.
Yep.
And so we just want to help guide you through that and show, hey, we've done this 50 times, so it's not new to us, and we can explain everything in a way that you can understand it. Nothing should be so complicated an owner can't wrap their head around it, and we just kind of guide them through the largest financial transaction of their life.
Well, let's talk about our team and why we feel like we should be the best fit for that. There's a lot of business brokers, thousands I'm sure, or quote investment bankers. I don't really like either one of those terms. That's why we call ourselves advisors. But I think we have the right team in place because we all have a unique skill set. I've been through the process. You've handled, a ton of transactions. Chad's been through the process and established a platform, which is one way that people can exit. And then Terry brings a wealth of knowledge, having worked for a private equity-backed company in the home service space. So in your opinion, if you're selling V2 Strategy Advisors, why would they choose us? We had a client this week in Illinois, and they have two great companies to pick from, and they ultimately chose to go with us, and I'm grateful that they did, which will lead into my next question. But why use V2 Strategy Advisors?
I think it's hard to find the diversity of experience amongst the entire transaction cycle as we have here. You know, I think I kind of fill that technical expertise role of being on the back end and kind of crunching the numbers, running valuations, doing things of that nature. But you and Chad have experience in the industry. You've been through a transaction. It's been your company. You can really speak to the emotional process, which is very important, and really preparing owners for that wave of emotions that comes with this, because it's a big deal, and I think most people underestimate the impact of that.
Okay, let's go step by step what the process is once we first engage with a client. So we can use the company from Illinois that we got good news they're going to work with us over the weekend. So an NDA, we send them an NDA, and then take us through the process.
Yeah, so we both sign a mutual NDA. I usually do an initial high-level analysis of where I think the value's at, and that's where I'm going to spread their numbers, look for anomalies.
So you're going to have a data request?
Yep, I'm going to have a data request. We're going to ask for copies of the past 3 years of full sets of financials, profit loss statements, balance sheets, general ledgers. I'll use that to start spreading the numbers, and then also, like I said before, kind of thinking of the industry. How does cash move through the company? What do I expect to see based on what they've told me and based on what I know about the industry? And I just start matching up, you know, what catches my attention in the financials, what doesn't immediately just make sense to me. And I start digging and asking questions. We get through that process, and at the end of that, we're coming to agreement on what we think market value is, and starting to build the marketing package, how we're going to go to market, what types of buyers we're going to target. Typically, we do targeted direct marketing, not indirect passive marketing, because most of our buyers are actively looking and they want to have these conversations. I think one of the disconnects is the buyers don't know how to find the sellers, and sellers don't know how to find the buyers. And a lot of what we do is create that bridge, because we kind of have a foot in both worlds.
And I think during that time is when we're also talking to the owner about what do you want.
And that's just as important as the financial components.
They may take less money for the right situation.
Absolutely.
Yeah.
I mean, I've seen a buyer do it. They just felt better about a buyer.
Sure.
After meeting them, and they took, $500,000 less.
There's a local company here in Chattanooga. I know it was really important to the owner for the legacy and for the employees and the culture, and he decided to do an ESOP versus selling for maybe twice what he did the ESOP for. So there's a lot of different reasons. All right, next, and I can sure attest to this. Why do so many owners struggle with life after the sale? I think you're all caught up in the emotion of the transaction and preparing and the due diligence, and then the day finally comes. And, I've mentioned this before. If you just type in any ChatGPT problems that sellers have after they've sold their business, it's loss of identity. And I had that because at one time we were, the largest home improvement company in this part of the country with multiple locations, and I was on billboards and TV and magazine covers, and every time I went to dinner, somebody knew who I was, and then I wasn't one day. It just all stopped. So there's the loss of identity. There's opportunity confusion. And you, being my CPA, you saw all the endeavors that I was getting into, and it was at one time 15 different things, and so I was trying to fulfill that void that I had left.
I love that phrase. Opportunity always exceeds capital.
Yeah, you can't do it all. But there's, friends treat you differently. Former employees treat you differently. A lot of people, it leads to alcohol abuse, and for me, about a year it did. And luckily, I figured all this out, but it took me longer than it should have. Had I not had I wish I would have had somebody to tell me all this. That's not something most business brokers or investment bankers or your attorney or your CPA explain to you. But it's, in my opinion, it's just as important as
Well,
the
and to
transaction.
be fair, most of them have never lived it.
That's true,
They've
too.
always been. Now, mind you, when I'm a CPA doing your transaction, I will never be as emotional as you will be.
Sure.
It's not my legacy. It's not my transaction, and that's a unique perspective I think you and Chad bring. And frankly, one of the most important questions I talk about when we're talking about selling is, what's your plan for after? Because I tell you, the saddest thing when I started working in this business, the saddest trend I noticed was a lot of business owners would die after a few years.
Oh, it's a common. You can, it's a
Fairly
percentage.
healthy, and within 2 or 3 years of selling, they just kind of fade away, and a lot of loss of purpose. They didn't have a plan for after selling. They spent their whole life waking up every day with purpose. They knew what they were going to do. They're going to work. They're going to build this company. And then one day they wake up, no one's calling them, no one needs them.
Sure.
And I think that there's a piece of us that truly desires to be needed and useful.
How often do you see, and typically how long is the non-compete, non-solicit clause in these transactions? For mine, it was 5 years, and that 5 years has ran out, but I don't feel this big urge to go sell replacement windows and one-day bathrooms, and that's why I'm doing this.
You know what it takes to build that again.
Well, I find my purpose now in helping other business owners do what we're talking about. But,
and that was part of your journey.
Yeah, it took me some time to get there, but that was my journey. But how often do sellers get back in the market or reopen the door one day?
I would say the demographic of my sellers has historically been folks entering retirement.
Yeah, okay.
They're looking to convert their biggest asset to liquidity so that they can retire in peace. I have done younger or deals with younger folks. You know, someone in their 30s, that's not altogether uncommon that after the non-compete runs out, they're going to go start something similar.
Well, I think we're seeing a little bit more of that, where now there's guys that are younger, guys or women that are younger that have been successful and can exit. My first cousin built a great SaaS model business. He's, I think he's in his 40s, and, he can go do something again. So it's something for the seller to think about.
Well, and think about this. The beauty of exiting after a transaction is now you get to do things you want to do, not because you have to do them to make money.
That's very important.
And that's a freeing now it can be overwhelming sometimes because when all the options are available, it's hard to pick where do I want to focus on. But I say, you don't have to think about everything now as if, well, I have to earn a living out of this.
Yeah.
I've got my mom's boyfriend. He likes making bullets. And he created a little business. He just breaks even, but he's happy as a clam. He goes there, gets his little machine, punches bullets all day, and that's his jam. Yeah. And that's fine.
Well, and that's purpose.
That's a blessing.
And it makes you happy. I consulted with a gentleman this week. He had a successful exit in the convenience store industry, and he went back to the town he grew up in, and he bought the old golf course and spent a lot of money and redid it. Broke even for a few years. He's making a little bit of money now, but that's not why he did it.
Right.
He's having fun doing it. Okay, what's one number every owner should know but usually doesn't?
EBITDA usually is a fairly foreign term when I approach them. It's like they've heard of it before, but they never really understood what
I'm
it
shocked
was.
how many people I meet can't even pronounce it. So most people don't know what it means.
Or they heard about it in college and never since then. And that's probably the most common financial term we utilize, is just the overall benchmark test for how you're performing.
And it's not just for private equity. You need
Right,
to know
yeah.
that.
I mean, well, everything is kind of traded. Most transactions are traded on an EBITDA multiple, the vast majority, especially lower middle market. So that becomes important. But oftentimes they have a general sense of it. They just don't know that's what it's termed.
Explain for someone that, let's not take for granted, just because you and I understand it. Let's talk about what it truly means and the difference between that and net profit. I dumb it down and say it's net profit plus all your ad bags. But How would you describe it?
Yeah, well, I would say EBITDA is the closest approximation of true cash flow in a business. Because think of net income has non-cash expenses included, like depreciation. You have $100,000 of depreciation that reduces net income, but that didn't represent $100,000 going out the door, right? So what EBITDA does is it kind of takes out the non-cash expenses and converts it to, hey, what was your true cash inflow or outflow for this given period due to normal operations?
All right, what's one question every owner should ask themselves every year? I'm going to start, and I can think of a few.
Okay.
I would, of course, want to know my numbers, and are they accurate? What can I do to improve, and am I growing? I feel like if you're sitting still, you're going backwards, especially these days. So.
In capitalism, if you don't grow, you die.
Yeah.
And that is proven true over and over. I would say, I'm often shocked at fairly sophisticated business owners that have no understanding of their balance sheet. And I would really challenge them, when I look at a business's health, I probably focus more on the balance sheet than the P&L. And think about it this way. A P&L shows performance for a period of time. The balance sheet shows me in perpetuity how the company has utilized their assets to generate returns and what they've done with those assets. So it kind of shows me the full history book. And most business owners, I think the balance sheet intimidates them because it's not as logical as like the profit loss statement is. But it gives a lot more insights into the total health of the company, I believe, and the long-term health, and your ability to withstand short-term disturbances in the market.
All right, let's talk about the business owners that they don't know if they should sell or not. I remember a M&A attorney friend of mine telling me a story years ago about a father and son that had a business down in Georgia. They were in the construction industry. They got to the closing table, and the day before they said, we just can't do it. And it was a significant amount of money. 2008 hit, and they went out of business. And a lot of business owners, I feel like they think, well, I'm not ready yet, or if I'll just keep building this, and you can keep building it. But I think a lot of them might be surprised at the value they can get at the size they are.
Yeah, and I just always say, hey, look, our job is to bring you information, and it's your job to make decisions based on that information. But how can you make a wise decision without even accessing the information that would impact that decision? And so I just say there's no harm in at least always gauging where you're at. The seller always has full control. They never have to sell until they sign the dotted line.
Right.
But I would also say, most sellers, because it's an emotional process, because it's the first time they're ever doing it, they will, like most of us, when we don't understand something, we will over-assess risk and under-assess the benefits. And I kind of view it as our job is to pull back out from the emotion and lay out, yes, these risks do exist, but let's quantify these risks. They're not 0 or 100. Most people think a risk is either there or not there.
Right.
I quantify risk. I know risk exists. We put in plans to work around it. We can't absolve anything of all risks. There's macro risks, COVID happening, that no one can control. But the risks we can control, we try to do so. And really, we just quantify risk, and that's the conversation I'm having when those sellers are having those emotional moments, because those come up more often than many people think. It's kind of this emotional roller coaster. They're on a high when they get the LOI. Now, tell me if I'm wrong. When you went into due diligence, you probably thought, oh, man, is this even going to go through? Look at all these questions they're asking. It's kind of frustrating. Due diligence isn't much fun.
Oh, it was awful. And that's something we help educate them on and let them know, hey, this is going to suck for a little while.
So that's the emotional down. And then they start coming back up, coming to closing. But then if anything happens in that 2 to 3 week period, post due diligence, before closing, they tend to overreact because it feels so close, but yet it hadn't happened yet.
Let's talk about the timeline. And, Chad and I have talked before, he's closed pest control businesses in 60 days. You just had a transaction that took well over a year, but the owner was patient enough to wait for you to get a much higher multiple. So I know it varies, but in an average, what would it look like?
I'd say your average probably is 6 months from start to finish. And that's probably a month or so of making sure we understand their business well, can communicate it well to the market, have benchmarked it against other businesses in the industry, and then the marketing program probably take a month or two. And to your point, that year-long sales process, the directive from the buyer was, I want to get above the median fair market range. And we told them, okay, if we do that, I think we can achieve that, but we're going to have to create a competitive market, and that just takes time.
Sure.
So they at least bought into it, and it was their decision. And I found as long as we inform them on the front end of the impacts of their decision, then they can accept that. And so, yeah, we got 8 LOIs, turned down 7 of them until we finally got the one where we needed it. But we had to prove to the market we weren't going to take a 3X deal.
Well, let's talk about that, because I think a lot of business owners think, hey, I need V2 to help me go find a buyer, and they think there's just one buyer out there. Talk about how to make it a competitive market and increase the value.
Yeah, I mean, that's just to get as many buyers interested that have the ability to execute the transaction as possible. Because us finance guys, and especially in the private equity firms, they've all got finance guys that have access to the same data I do. So if they think they're the only one at the table, they can often get away with the bottom of the market offer, because the seller might not have any information to combat them with, and they don't really have any leverage because they got nothing to go back to.
All right, so last question, James. If a business owner listening today wants to maximize their options in the future, where should they start tomorrow morning? For me, it's, again, having a vision and know where you're trying to go. But what would you do?
Yeah, well, again, I think it's the boring answer, but it goes back to just doing the little things right consistently. That's what stands out in business, is the guy that for 20 years follows through every time. Not the guy, anybody can come in for 2 years, disrupt a market, and do things well, but it's doing it for 20 years over and over consistently that's the separator.
Yeah, and seldom is there a one-hit wonder. If you eat really good tomorrow, you're not going to see a difference. But if you eat really good tomorrow and the next day, it's just like going to the gym. All right, so any last words for any viewers out there? Of course, we want you to call us, V2 Strategy. We'll be happy to have a free consultation call with you, and would love to start the process.
Yeah, I mean, this is just what we love to do. It's incredibly rewarding to be able to retire people that thought
Change their life.
they may not be able to retire.
Yeah.
So yeah, we love doing what we do. We've dedicated our careers to it, and our focus and energies. It's all we do is transaction work. So we'd love to help you.
All right, thanks for being a guest today, James. We'll see you next time on the V2 Podcast.